Morning, Market Chameleons, and my man Dimitri Pargamonic coming in from Philadelphia. How's everyone doing this morning?
Good morning, Will. How are you?
Awesome. Good start today. No technical issues. All the chameleons are back saying hello, which is great. All right, let's start with the disclaimer.
All right. Good morning, everyone. Thanks for joining. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions, provide you with guidance. There's the disclaimer, everyone. And with that, let's get started.
Excellent.
I'm going to share my screen really quickly. I think what we'll do today, Will, is we'll go over what's moving in the pre-market hours. And I think we'll take a look at sector rotations. We haven't done that in a while. I want to come back to it, talk about sector rotations, how we could kind of detect it, view it. And then if we have time, I'll take a look at some bullish, bearish trade ideas. And of course, if we have questions along the way, let me know. I'm going to try to answer as many questions as I can before the end of it. So here we'll start out with stocks that are moving in a pre-market hours or trading in pre-market hours. We got the most active stocks here. We got the biggest percentage gainers, biggest percentage decliners. I'm going to use my filter here for market cap and filter out for stocks with higher market cap, see what's going on there. So let's do 20 billion market cap or higher. So we could see here 48 made the percentage gainers list, 26 are the percentage decliners list. So from that perspective, it looks to me a little bit more bullish opening or bullish bias at the opening, given the breadth of up movers versus down movers. Here, top of the list, OXY up 4.2% on 218,000 shares. I might actually mention some of these stocks, so I'm going to just kind of go down the list as we talk about sector rotation. BCS up 3.7%, HSBC up 3.3%. So a couple in energy financials we're seeing on the top of the list. XLE, energy sector up 2.6%. Let me take a look at the unfiltered list real quick. And, we got some this one's a lower market cap stock, 14.9 million. Let me see real quick. I don't see the headline news on it. That's up on 1.7 million shares, 100% FLGT, up 32% on 74,000 shares. Looks like that's in earnings. Got CLPS up 30%, also low market cap stock, 66 million market cap, trading 5 million shares. That looks like that's also reacting to an earnings report. Nothing sticks out at me right now to open up unless you have specific questions. I'll dig deeper into a pre-market mover.
Yeah.
If not, I'm going to just move on. Let me know if you have questions. I'll come back to it. Is that good, Will?
Yep, perfect.
So let's take a look at sector rotation. Where do we think institutional money or just money in general is moving? How's the flow of money moving from one sector to another? So I'm going to go under the options, and this is probably one of the easiest ways to maybe demonstrate this. So what we want to know is, that you could always have a one-day big move, right? That might not mean that much, because if it moves one day, money goes into it really quickly. It could go up a lot and then it's over, maybe reacted to news. Or a stock could go down really quickly, reacting to news, and it just gets repriced. But a rotation is something different, where there's deliberate money slowly moving out of a sector, moving into a different sector. And if you think about like mutual funds or big hedge funds that are trading, managing tens of billions, hundreds of billions, of stock and portfolios, they don't do it in one day. They're doing research and slowly VWAPing. Their VWAP orders could take months to liquidate some of their positions and get into different positions. And that's how they will usually do it, because imagine, big mutual fund, if they had to sell all their stock all at one time, they'll just crash it, or buy one stock all at one time, it'll just explode, it'll crash to the upside. So it's usually VWAP orders, in aggregate moving from one place to another, and takes a long time, and it actually shows more conviction, right? If you're doing it steadily over time, because as you're doing it, you're also confirming your research day after day after day to do it. So now nobody, it's hard to detect how that's actually playing out through the overall market, because it's not just one mutual fund or institutions that's participating. We're trying to look at it in aggregate, what's going on. And what we talked about is some of the things that we use on the website, we are tools that professionals use, in which will be benchmarks, statistical analysis, pricing models. And here, this is where benchmarks kind of come into play. And I'm going to show you a simple benchmark, right? How can we possibly gain some insights to it? So here what we have is, this is the SPY, S&P 500. So that represents, the top 500 stocks that are diversified, and it's diversified through all the sectors, all the different sectors that we have here. So if we take the S&P 500, if we break it down in the sector ETFs, then we have the consumer discretionary, consumer staples, energy, financial, healthcare, industrials, metals, technology, utilities. I think actually real estate's also, I'll add that one. Real estate's another sector in that S&P 500. So all these make up the S&P 500. And what we want to see is, okay, let's use, to see how things are flowing, we first need to establish some benchmarks. So the benchmark will be the S&P 500, the overall market, right? So this is the overall market, and we want to compare how does each sector behaving relative to the overall market, and this could kind of give us a sense of how things could potentially be rotating. So I'm going to look here. So here we have the performance up here. These are the implied volatilities. I'm going to jump down to the performance. We could talk about the implied vols afterwards, but let's just take a look at the performance here. And we see this is the S&P 500, how it's performing over a certain period in time, right? So we got yesterday, we got a 2-week performance, 3-month performance, 6-month, 1 year, and year to date. And we know that in the last year, just following things, technology did really well. So here's the technology in the last year. In 1 year, on a 1 year basis, technology sector was up 34.9%, almost 35%. So that looks like that was the best performing sector on a 1 year basis, and definitely higher than the overall benchmark. So that outperformed the benchmark on a 1 year basis. But look, now we're going to more short-term and intermediate, and this is what's happening more recently. That technology sector on a 6-month basis, up 7.2% versus the overall market 10%, right? 3-month basis, it's up 0.4% versus overall market 1.9%. What about when the market's down? Last 2 weeks, market is down 3.6%, technology down 7.1%, which is kind of indicating here that it's starting to weaken relative to the overall market. So if we use that as our benchmark, what we're seeing is that perhaps now people, or these institutions, they're lightening up. The demand is not as high. There's some pressure there leaving that sector. So where are they going? So is this making sense so far? Will, let me know if you have questions, right? So we're using the price performance and benchmarking them to give us an indication what we think might be happening. So think of it this way: if we had the median price of homes throughout the nation, right? And the median price of homes are, let's say, increasing 5%. We could look at, well, where are their counties or states or cities, and how are they performing versus the rest of the median market? You know, where is it weaker? Where is it going up? Where is it going down? So that's the technology sector here. Another, observation is where might that money be flowing? So let's take a look at the energy. So we see the energy on a 1-year basis definitely, underperformed, 9% versus 20% on a 1-year basis. But look at the shorter term, 46% in the last 6 months versus 10% in the S&P 500. Last 3 months, energy up 25% versus S&P 500 up 1.9. Last 2 weeks, we're up 12.4%. SPY up down 3.6%. Yesterday, up 2.4%. SPY down 1.2%. So we're trying to gain a picture where are they flown out of and where are they flown into, right? Because we kind of want to see that slow rotation, because that money supposedly is more committed, right? The institutional money, that the more money flown in, it's more committed. So that's one way. Let's take a look at another place where they're possibly rotating. Look at the financials. So the financials right now, year to date, they're about, I'm sorry, not year to date. On a 1-year basis, they're catching up to that S&P 500, up 19% versus S&P up 20.4. But look, it's been happening more recently, right? So the 6-month financials up 30.8%, SPY up 10%. 3-month basis, except financials up 14.2%, same period, SPY up 1.9. 2-week period, financials up 3.3%, while the market was down 3.6. And then yesterday, outperformed by a little bit, down 1.1% versus SPY 1.2. So this is kind of getting us somewhat of a picture what might be happening as far as rotations in sectors within the S&P 500. Is that making sense? Will, let me know if you're seeing any questions popping up.
Yeah, it's super interesting. I mean, it's amazing when you think about the last time we had a major run up in technology stocks in the early 2000s. I mean, it took almost 2 years for the QQQ from top to bottom. I mean, it was a long rotation. It doesn't.
It's a very long rotation. Yeah. If people notice that this energy sector, if you go back, you go back right now, it's outperforming, but it was a very long rotation out of it, right? It was just going down. So you're going to have ups and downs, right? You're still going to, from day to day, it's not going to match up because it's not happening fast. It's happening methodically, slowly, where it's VWAPing, they're skipping days, they could be skipping weeks, but eventually it starts to show up if it's strong enough, right? And that's where but to detect that, we kind of have to start benchmarking and gaining some insights into the way it's moving. Like here, utilities, they look like they've just been underperforming here, throughout the whole period. They've been underperforming. We could also take a look like what's moving within those stocks. So I see here, last 2 weeks, this was a pretty big move in the consumer discretionary. So I'm just going to take a look at that into the XLY. I'm going to open up a new window for this ETF XLY. And let's take a look at the information. I'm going to go ETF info, look at the holdings. And you might be surprised what's moving up in there and what's moving down. So consumer discretionary, right? If we take it the last 2 weeks, what's pulling it down? So we see Tesla, Best Buy, eBay, Lowe's, right? So some of these are surprising stocks that are starting to pull it lower. Look at but even within here, even within the consumer discretionary, we might start start to detect rotations within it, right? So watch this when I put and you can see Home Depot, Target, Amazon, all pulling it down. Let's take a look where in the last 2 weeks money's flown. Look, Norwegian Cruise Lines, Royal Caribbean, Carnival, Wynn. What's the market trying to tell us? Marriott, a lot of these have something in common, right? Like the top three definitely all in the hospitality industry, or what would you call that?
It's the hospitality industry, resorts, travel.
Right.
It's the Corona coming to an end play, and those are the survivors potentially.
Yeah. Now I don't know what's right. That it remains to be. They are lower market caps, right? Not as high as market caps as the ones bringing us down. So let's take a look at the two week. You got the $600 billion market cap, 112 billion market cap, 270 billion. So these are a little bit higher market cap stocks bringing us down, but versus these that are 10 billion, 20 billion.
I hate to interrupt you, but we have some chat on. They think what you were showing them on the sectors is a new feature, and they were asking when is it going to be available. That's been available for quite a while, right? Can you just replay how you get to that sector?
So if you go under options, and it's under the snapshot, all right? So if you just take options, go under snapshot, I'll come back to it. So I'll click on there. So on the top, you have two tables here. One is showing where the implied volatility is, and this is just letting us know, where the options are priced in terms of implied volatility relative to the previous year. So SPY, if we took a look at the last 252 implied volatility observations closing, where the implied volatility closed in the last 252 days, 53.8% of those days implied volatility was lower. The rest were higher. So we think that's, right in the middle. So that's moderate. Once it goes above like the 70, I think we have it pegged at 76%, something like that, then we'll say it starts to get a more elevated indicator. Okay, so right now they're in so even with the sell-off so far, not a lot of fear priced into the options as far as relative to the last year. So this will give you a snapshot of what the options are doing. Down here, this is the performance. One second. Oops. This is the performance of the sectors within the S&P 500. Let me see if I think we also have other comparisons if you wanted to do like gold, TLT, QQQ, IWM, but this is within the S&P 500 rotation. Is that
very cool? Yeah, that was helpful.
So let's take a look at another one where what is moving. So we saw that in the consumer discretionary, some of the stocks, high cap stocks moving us down, where people though are putting within that industry, where people have started to put money in there. That'll be an interesting play, going into those cruise lines. Financials, let's take a look, or energy. So here we go, energy is moving up. So let's see what's going on in that energy space and which stocks are getting pulled up in there. So I'm going to open up that XLE, right? Let's go to the XLE. We'll go to the ETF info and look at the holdings. So right now I'm in the holdings. Let's see in the last 2 weeks. So in the last 2 weeks, here are some of the top gainers, right? OXY, that was popping up today, I think in the pre-market. APA, so I'm kind of looking at a little bit of the higher market cap. XOM, ExxonMobil, that's up here in the list, up 12%. Let's look up in the last, let's see which ones are under. So I just sorted last 2 weeks, and you see I don't even have down movers in the last 2 weeks. So all these 23 holdings were up on a 2 week basis. Let's do a 3 month. So even a 3 month, I'm sorting, all of them are up, which is pretty strong. It's just showing that, you know, they're getting, you know, that sector, a lot of money getting pushed into that sector, and it's getting spread out throughout all the stocks. So that's in the energy space. Let's take a look at, I'm going to come back. What else do we have here? Financials. Let's take a look at the financials. So here's the financials. Let's just see what's been. So you see financials are mixed. We have down ones in the last 2 weeks and stocks moving up. So here's some of the best gainers in the last 2 weeks. PBCT, State Street, AIG, AXB, American Express. That was a higher market cap stock. Morgan Stanley. Let's see some of the losers here. So here are some of the losers here. You know, NASDAQ down 4.5% in the last 2 weeks. So again, even within the sector, you could see what's going on inside that sector, what's pulling that sector higher, or what could be a downdraft on that sector. I'm going to take a look. Here's an interesting one, though. Healthcare. You know, so the healthcare, which was surprising to me, that's also been a laggard, right? Almost for all the time periods. And I know that if we look at SPY, I'm going to leave this. Let me just go to the SPY real quick. So in the SPY, now this is not this. I'm not sure if this is available. I think it is right now. I think that these financial ratios are available. But if we look at the SPY and we look at, again, the benchmarks, where's SPY as a whole being priced relative to historical valuations? So where are the valuations today versus the historical valuations? And we talked a little bit about it yesterday. So we got here, let me just see this real quick. So we got here, price to earnings ratio, 37.97, 3-year average, 25.74. So that's 48% premium to the historical 3-year benchmark. In other words, if we took and bought all the stocks, all the holdings in the S&P 500, you know, and we took that market cap, what we paid for it, and divided it by all the earnings for the year that we would make, and took that ratio, it's 37.97. On a 3-year average, it's 25.74. So that's a 48% premium to that historical benchmark. Price to sales, 20% premium. Price to book, 14% premium to the 3-year benchmark. Price to operating income, 37%. So if we took that average, right now we're looking at, you know, people are pricing in a very bullish, optimistic view of the market because we're at 30% over our historical multiples. In other words, either the earnings are going to catch up quickly, right, in the next year. Maybe the stimulus will help that, or we're going to be sitting here for a while, you know, until the earnings catch up. So not a lot of appreciation, or the market has to come back down. You know, but we're at 30%. Look, let's take a look at how one of these sectors, so healthcare sector, we see did not go up as much, right? So let's see where the XLV is. XLV, healthcare sector in the S&P. So see here, we're only 9% above our historicals, 14% above the PE, 2% price to sales, 10% above for the operating income. So 9% premium, which is not too bad, right? 9%. If you think that revenue, you know, that the revenue will start growing a little bit quicker pace, net income grows a little bit quicker pace, you could kind of cover that. So really quickly, that's another way to look at it. How far did we go away? How far are we from our historical valuations? You know, what are the markets, you know, are they pricing in optimism, pessimism, and how are the other sectors relative to the market? Does that make sense? Well,
yeah, it's great.
Okay. Are there any questions popping up?
We had a question earlier that I wanted to ask you. It says real time doing.
Take a look at the technology as well.
All right. Someone was asking when do you think MC will have calendar or diagonal screening capabilities? Is that even possible?
So that one is more challenging. So not anytime in the immediate as far as screening goes, so what I think the question is, can I screen for calendar?
Yes, exactly.
Right. So as far as screening goes, it's much more challenging because one of the things we do with our screeners is also create those benchmarks, just like we're having here. So you could kind of get a sense of, well, is it a good deal? Is it undervalued or overvalued relative to the benchmarks that we're using, which are usually, using 3-year, 6-year historical data and other things that we're putting in there. But with the problem with the diagonals and especially diagonals, first of all, there's lots of different combinations and there are different expirations. So unlike a vertical spread, both options expire at the same time. So it's much easier to compare when both of them expire at the same time because they have that in common, right? Time to expiration, any types of events that are going to cover it, they both cover that event, right? So if there's an earnings before the expiration, they'll both cover, the earnings. If the earnings are after expiration, they both do not cover the earnings. So that's in a vertical spread. Diagonal and calendar spreads, there's a lot more going into them because what do you do, when one option expires? Well, the other option will still have time value, right? And then you have to estimate, well, what is the time value? One goes to 0, one still has time value. So you have that challenge. The other challenge is, what if there's an event in one, not an event in the other, and all these different. What if there's a dividend in one? So it is more challenging, and and how do I simplify it? Not only do we, because we're creating these analytics, and then the problem is, how do you simplify it where people kind of go to but the answer is, I'm working on it, right? Excellent. I am working on it, and at some point it'll get there, but I'm not there yet. But how do I simplify to, like, here's the prices, here's what we think it's worth. So here's your edge, here's the probability of success, right? And this is the spread. So how do you do that with a diagonal or calendar? Again, it's much more challenging, and you got more moving parts in that type of a strategy.
Now, we did have some questions about Tesla. If there's anything showing up on Market Chameleon relative to the options, unusual options or trades or anything like that in Tesla.
So let's just take a look here. Tesla. Oops. Hold on. So here's Tesla. As far as option right now, the flow looks like it's gone from bullish to bearish, probably, as we're selling off here. I'm just going to take a look at even with the sell-off. Look, as far as the IV rank goes, we're at 51 percentile, so moderate. So I don't think there's like lots of fear being priced into it right now, at least not at this moment. It's going up, implied volatility, but I would say it's in a moderate. Let's just take a look at the trading stats here. And, I'm just seeing, that it's definitely in the last month, starting to underperform. I think it's really like, it's a valuation. The problem is it too high of a valuation? So far, I don't think there's nothing wrong with the company itself. There's no like lawsuits, litigations. There's no, I don't think that's the problem. The problem with it is the debate is, what is its fair value? Like, what's the valuation? This is, if we use the 3-year historical valuations, price to sales, 3-year valuation, price to sales versus the rest of the market. We don't, and we can't, some of them we can't even use because the, price to earnings are too high. So we just skip it. But even if we just stuck to the price to sales, it's coming closer to its fair value. Let me see the median. Let's look at the 5-year. Oops. Yeah, so I don't even have this. So, it's that, I think this is the question is, did it just get, was it just very richly priced, right? Like I think that was the debate that's going on. Same thing, like maybe with some of the technology stocks.
Well, it is a technology stock, really.
Yeah.
Amazon.
Yeah, I would say it is. Yeah. So we're right at 9:30.
All right. Great job, Deem, as always. Thank you so much. You have a good Friday, buddy.
Thanks, everyone. Thanks for joining. Have a good weekend. Stay safe. Have a good trading day. Hope to